Okay, good morning and welcome. My name is Brian Siegel. I am BUI's Director of Advanced Planning, and I'm very excited to introduce our speaker today. But before I do, I've got a few housekeeping items to cover. This meeting is approved for 1 hour of CE credit for CFPs anywhere in the US, Missouri Life and Health, Indiana Life and Health, Texas Life and Health, and Missouri MCLE. We will post a link in the chat to sign in for CE. So if you want credit for today's presentation, then please make sure to complete that form accessed through the link. If you have a question during the presentation, please post it in the Q&A. We'll do our best to answer as many questions as time allows. Also, for today's presentation, we're going to ask for your participation by using Slido to anonymously answer a few questions along the way. You can scan the QR code on the left side of the screen that you see now, or visit slido.com and enter the code that you see on your screen now and join as a participant for the meeting. In our last webinar, BUI's Vice President, Brant Steck, talked about the basics of long-term care insurance planning, and that included a summary of the products available in today's marketplace. And today's presentation is focused on how clients can pay for their long-term care coverage. So without further ado, to talk about today's topic, we're going to welcome back Brant Steck, our Vice President at BUI. And Brant leads the charge in all of BUI's marketing efforts. He's an excellent resource available to you and your clients in analyzing clients' planning needs and presenting options that'll best address those needs. I can tell you from experience that there's no one you'd rather have presenting options to your clients than Brant. He's a certified financial planner with almost 2 decades of experience in the insurance industry. And today, Brant is going to talk about creative funding methods for long-term care insurance. Brant?
All right. Well, thank you, Brian, for the introduction, and to all of our audience members, welcome. So as Brian mentioned in our previous discussion, we really focused on the ever-growing need for long-term care insurance, the supply and demand problem in America, the immense burden of unpaid family caregiving, and really the general product options available to clients. Today, we're taking the next step and focusing on creating plans that best address client goals and objectives, and to provide creative funding ideas that make implementation as comfortable as possible for your clients. So Brian mentioned that we have Slido as a means of engagement. So we're going to start with Slido right away. So on your phone or maybe another screen, go to slido.com. And here's our first poll question. In a 2023 study by One America and Hanover Research, what percentage of respondents have worked with a financial professional on a long-term care planning strategy? And I'll give everybody a few seconds to put their answer in here. Again, slido.com, enter 1819375. Oh, and I see we've got quite a few responses already. Great. Okay, and the answer here is 18%. So you all guessed it correctly. So a little less than 1 in 5, and I think that creates an excellent opportunity for all of you insurance and financial advisors to bring unique value to your clients. You being the trusted advisor that has knowledge of their finances, their goals and objectives, because you really have to think it like, if you're not the one that's having the conversation with them, how are people otherwise becoming aware? And here is a graph that shows the source of initial awareness for the need for long-term care insurance planning. And it's really number one answer is life experience when they run into it, whether they are being a caregiver themselves or have seen a friend or a family member, just life experience. So the asterisk there is shortened for family member or friend who need a long-term care. But really, I think the takeaway here is, sometimes the advice we get specifically about finances may not be the best coming from friends and family who have different perspective, different background, different education, but also different goals and objectives. And you're going to see later in this presentation that there's significant evidence that suggests that clients are thinking about this topic. And again, a unique opportunity for you to have a meaningful discussion with your clients. So we mentioned the previous meeting, that was an introduction to long-term care insurance, but that session wasn't intended to be a prerequisite for this meeting. So to make sure that we're all on the same page, I'm going to quickly recap the need for care and recognize that I'm doing here in 5 minutes what I did in an hour previously. So that meeting was recorded, so you always have the ability to go back and reflect on that if you need additional information. So the first thing that we covered was the need for care, and recognize that when we're talking about long-term care, we're talking generally about custodial care. Clients still need medical insurance for skilled medical care. Custodial care is for assistance with activities of daily living, eating, bathing, dressing, toileting, transferring, etc. When we become unable to do those things ourselves, we need help, and that's where custodial care comes in. And in America today, we have a rather significant supply and demand crisis as it relates to custodial care. In a poll that was conducted by the American Healthcare Association, 99% of nursing homes and 96% of assisted living communities communicated that they're having staffing shortages, with many of them communicating it as, or describing it as, severe. That's before the baby boomers advance into their later years. So a giant population of over 70 million Americans ages 58 to age 76 are on the doorstep of needing care, and we're already busting at the seams. And then we go into the cost of care, which is quite significant anywhere you go in the country. Yes, in the coastal areas, it's higher, but the median cost for a private room in a nursing home today in America is $108,000 a year in today's dollars. And that's for a median facility. And if you've ever seen a median facility, it's probably not the quality of lifestyle that you're likely accustomed to. So that 108,000, again, likely going to continue to grow with inflation as we try to attract caregivers into long-term care facilities and home health care facilities alike. But the cost is significant. And that kind of underscores the need to plan, because if there isn't planning that's getting done, there is a plan. There is a default option, and I think it's really important to understand. The default option, if there isn't a plan for long-term care, becomes family members. Today in America, 53 million Americans that's 1 in 5 American adults is providing unpaid family caregiving. And when you look at the statistics, particularly the ones I shared in the last presentation about the toll, the mental, physical, and financial health toll on those family members, I find it hard to believe anyone would knowingly want to put that on their loved ones. You see people paying for funerals because they don't want their family to have to deal with that expense. This is a much greater burden and much greater financial expense than even a funeral. So from a product perspective, there's 2 basic product types. And again, I'm speaking here in generalities, covering a broad topic in a short period of time. But for many years, traditional long-term care insurance was all that was available. But today represents a very small percentage of the overall market. These products offer an initially low premium. They have asset protection for Medicaid spend down in some states. But the downside is these products do not offer a fixed or a guaranteed premium, short pay options, or a death benefit. So most of them also don't include return of premium options. So these are commonly referred to as use it or lose it products. And when you have a client that's coming in and saying, I've got this rate increase, I'm not sure what to do, nearly every time it is related to traditional long-term care insurance. Hybrid plans are, generally speaking, life insurance policies with long-term care insurance riders, but make no mistake, the motivator for purchase on these plans is the robust long-term care benefits. The most popular plans in the market today offer robust guarantees: guaranteed premium amount, guaranteed premium duration, guaranteed long-term care benefit pool, guaranteed inflation protection, guaranteed return of premium options at surrender, and a guaranteed death benefit. The cons with these products are that they are initially a higher premium. They don't provide protection for Medicaid spend down, and the underwriting process, being underwritten for both life and long-term care insurance, can sometimes be a bit more stringent. That said, again, in today's market, these hybrid products represent the vast majority of what's purchased and is largely the focus of our discussion. But not all hybrid plans are fully guaranteed. So you always want to make sure that you read the illustration, particularly the guarantees in the illustration, before you ever make the recommendation to a client. So back to Slido. And by the way, if you stay on Slido, the questions will automatically populate once we get to them. So next question, this one's a true or false. In a survey conducted by One American Hanover Research, 43% of financial service professionals would be more likely to recommend long-term care insurance, quote, if there was a guarantee my clients would receive a benefit under the policy. Is that true or false? I'll give everybody a few seconds to enter in their answers. And again, you can go to slido.com and enter in 1819375, or use your phone to scan the QR code.
And while everyone is entering their answers on Slido, it appears that the chat box is disabled. So instead, we are going to post the link for CE sign in on the Q&A. So please make sure, if you would like credit for today's presentation, make sure to click the link that will be in the Q&A and go ahead and complete the form through that link.
Thank you, Brian. Okay, and the answer is true. So I think this is really important to recognize that I think many insurance and financial advisors have become a bit disenchanted with long-term care insurance because of the rate increases, meaning clients come in looking for direction year after year with what option to take with the latest increase in their traditional long-term care insurance premium. And it's like, oh, I don't want to be on the other end of this, having been the one that made the recommendation and now trying to explain why the premium wasn't fixed. Understand that today there are products available that offer more robust guarantees. And with these plans, whether a client lives a long time or passes away, there's assurance that they're going to have a benefit for their family. Okay, and that heads into our agenda today. So we've broken up our presentation into 3 parts. Case studies with ideas on how to fund long-term care with existing assets. Number 2, the second part, is funding with current income, higher income earners, particularly in their 50s and peak income earning years. And then part 3 is funding through third parties. So in each section, what I'm going to do is I'm going to share an overview of a client's background, their profile, their goals and objectives, the assets that they own, and then give you a broad overview of the solution. Then we'll go quickly through the mechanics of the solution, how it mechanically works between their existing assets and the long-term care insurance, and then we'll hit on the key benefits. And I think the benefits are a really important takeaway here because, you identify the need, you have a conversation, and I think we all start looking at these illustrations and multiple carriers and what's guaranteed and what's not guaranteed. And then the clients are focused on premium amounts and duration. And we end up getting away in the conversation from how the product is going to benefit them and how it's going to benefit their family members. So in each of these case studies, at the end, we're going to go through the specific ways that the insurance recommendation ultimately benefits this client and helps them achieve their goals and objectives. So we'll start out, as I said, with funding with existing assets. We'll start with Jill. So Jill, in 2001, purchased a variable universal life insurance policy. She had a young family, wanted to protect them in the event of her passing. She also, kind of a secondary benefit was that she liked the idea of having a cash value that she could potentially use in retirement for supplemental retirement income. Here in 2023, her needs are different. Like most decades later, the needs change. And her children are now grown and they're financially independent. And she's worried about what longevity could mean to her kids and the burden of care that could be placed on them if she doesn't have a plan. She also wants to leave her kids in a better position than what she felt like she was left in when her parents passed away. So legacy planning was also an important factor to her. So to help her better accomplish her goals, we looked at what we call a split 1035 exchange, which is a 1035 exchange into a product that would provide longevity protection, but also provide a guaranteed legacy for her children. So let me kind of go through the mechanics of how this all went down. So we have her existing carrier, and with her existing carrier, this is basically what her policy looked like: $253,000 death benefit, $140,000 in cash surrender value, and a $5,100 premium. We did a 1035 exchange of her existing cash value. The benefit of the 1035 exchange being that it's a like-for-like exchange and is a tax-free exchange from one carrier to the other. So rather than surrendering the plan, paying taxes, and then using that as a lump sum in a new product, the 1035 exchange kind of helps maintain the tax deferral of the gain. So once that carrier receives the split 1035 exchange, we have them split it up. Now, not every insurance carrier will split up a 1035 exchange, but there are a number of carriers that will, enough where it's it makes sense to have a discussion in our meeting today. So in this case, we split up the 1035 exchange and put $97,000 towards her long-term care. That at age 85 would provide a benefit for her of $728,000, a pool of money for $728,000 for her long-term care needs when she needs it, or if she doesn't use it, it provides a $120,000 death benefit, or she can surrender and get back $68,000 if she has a different need in the future. Now, that death benefit drops dollar for dollar, and this is generally true with hybrid plans based upon what is spent on long-term care. So in this example, let's say Jill used $50,000 of her long-term care money and then passed away. Her death benefit is going to drop from $120 down to about $70,000, pay income tax free to her beneficiaries. If she goes through the whole 120, these plans generally have a residual death benefit somewhere between $5,000 and $15,000 for final expenses. So no matter what, there is a guaranteed death benefit. So she has a robust long-term care insurance policy, and then the rest of her 1035 money gets put towards a life insurance product, death benefit focused product. In this case, for her same premium of $5,100, she has a guaranteed no lapse death benefit of $822,000. So she has increased her legacy by at least $568,000, plus secured her future in terms of care and becoming a burden to her children. So as we consider the benefits for Jill, who again, key benefits, didn't want to become a burden to her children, wants to leave a legacy, the benefits number one are family harmony. She's making sure that she isn't a burden to her children. She wants her kids to come and see her because they want to come and spend time with her, not because they have to take care of her. A big difference in a relationship with your children. Number two, she has flexibility. If the long-term care insurance goes unused and she passes away, the legacy to her children just increases by way of the death benefit on the hybrid plan. She also has the peace of mind in knowing that if she wants to surrender and give back a substantial portion of her premium, she can choose to do so. Number three, she has very comfortable financing. Remember, she just increased it, just provided a large pool of long-term care funds and a much larger death benefit than she has today without increasing her out of pocket. We truly just moved money from her left pocket to her right pocket and repositioned it to better align with her goals and objectives. And she has increased her legacy to her children, again, leaving them in a better position than what she felt like she was left in. So, all things considered, a lot of benefits for Jill that directly alleviate her goals and objectives. Now, a common question at this point would be, well, what if the insurance product that she currently owns is not a life insurance product, but maybe a non-qualified annuity? The quick answer is there are similar options available, but rather than a life policy with a long-term care rider, there's an annuity policy with a long-term care insurance rider. So remember 1035 exchange rules. You can go life to life, annuity to annuity. You can go life to annuity, but you cannot go annuity to life. So in this case, it would be an annuity to annuity if they currently own an existing non-qualified annuity. Whoops. Okay. So, all right. So another asset that can sometimes be tricky to make best use of is qualified money. We've all been trained, never touch that money. There's penalties and there's taxes. Heaven forbid. It's almost like you're going to get electrocuted if you touch it. So maybe there's a better use for those dollars as we look into our retirement years. So for that example, let's meet Mary. Mary graduated from college in the early 90s and joined the workforce, where she immediately began contributing to her 401k. After several years of employment, she left the workforce to start a family. And at that time, she rolled her $15,000 401k into an IRA. 30 years later, here we are in 2023. And like Jill from our previous example, life is different. Her IRA has grown to about $146,000, and she has developed a robust, non-qualified portfolio. And again, been trained never to touch that IRA due to taxes and penalties. And now, even at age 60, where she's no longer penalized, she's struggling to find a purpose for the funds. Every distribution is fully taxable, so she prefers to access funds from her non-qualified assets. And then, what to do with the IRA? It's not an efficient transfer asset. At the same time, Mary is a very private person. We all know this person. We all have clients or family members who are this person. And she doesn't want her kids knowing her medical information and is really uncomfortable with the thought of anyone having to provide her care and the potential invasiveness in the provision of care, meaning bathing, dressing, toileting. That can cross a line for some people that's very uncomfortable, and Mary falls into that camp. She's also grown very accustomed to her quality of life and doesn't want to sacrifice her standard of living when she needs care. So for Mary, we explored using the IRA as a means of funding her long-term care insurance to provide her with protection, to put her the asset to better use, and to better align with her goals and objectives. So mechanically, this is how it kind of broke down. So she's got this IRA, and through the IRA, we take 10 years of withdrawals. Each year, there's a withdrawal of $14,680. So $14,680 being withdrawn every year for 10 years. $4,680 is put aside to account for taxes so that we're not increasing her annual tax bill. And then $10,000 is going to the insurance company. And assuming that she is leaving this money invested while she's making this withdrawal at a 6% hypothetical rate, there should still be a substantial balance left at the end of those 10 years. So $10,000 goes to the insurance company. On day one, she has a nice pool of long-term care money, but we're not so worried about day one, because if we were worried about day one, she probably wouldn't qualify for the insurance. What we're really looking for is down the road, more likely at claim time, what do her benefits look like? And for her, she has a pool of $711,000 for long-term care funds, $105,000 death benefit, and $81,000 that she can walk if she wants to surrender and walk away, she can. And by the way, you can increase the return of premium amount to 100% if the client wishes to do so. Most opt not to do that in order to really maximize their long-term care benefits. But in this case, she's got $9,100 a year at age 85, which is a 8.6% internal rate of return on the dollars that she contributed, and income tax-free benefits. So the pre-tax equivalent being much higher. So when we go to think about Mary and her goals, remember her lifestyle is important to her. Her privacy was important to her. So the benefits, number one, are that she has protected her lifestyle, which is important to Mary. She has seen what you would refer to as median facilities, as I mentioned earlier, and wants no part of them. She has a lot of peace of mind in knowing that she has positioned herself to be in a high quality facility where she'll be comfortable and cared for. Secondly, she has clarity. She didn't see herself ever touching that IRA, was unsure how to make it work for her. This strategy better aligned with her goals and objectives. Number three, Mary's protected her privacy. She felt the provision of care with her children would be awkward, embarrassing, invasive. She's much more comfortable with the idea of professional caregivers. And number four, she's reduced the likelihood of having animosity among her children. So without a plan, one child is generally disproportionately impacted by having to coordinate or provide care. That child most likely is the one who lives nearest to mom and dad, particularly if the other siblings live far away. With the concierge services at the insurance carriers to help with coordinating benefits, and by having professional caregivers, that takes a lot of strain off the children and really helps to maintain harmony in their relationship, which is very important to any parent. Okay, so now we've talked about a couple of ideas on funding with existing assets. Let's move into funding with current income. So generally designed for higher income earners, usually individuals in their late 40s, early 50s, entering their peak income earning years, and who have the desire to use those higher income earning years to have their long-term care insurance paid up before they end up being on a fixed income in retirement. So for this example, we have Jeff. Jeff is a very successful surgeon, has a very high income, top of his field. But Jeff has some family history. His dad was also very successful in his own regard, but he had early onset dementia and depleted a significant portion of his portfolio and his assets, and therefore the legacy that he left behind when that occurred. And Jeff saw that firsthand, and it's on his mind. He doesn't ever want to become a burden to his children. He doesn't want to deplete the legacy that he left behind, and he's also, or that he's leaving behind. He also, while he has a big income, we all know high income earners that, yeah, they have a big income, but they also have significant financial obligations, and he's not super interested in carving off a six-figure single premium, given his other financial commitments. So he's anxious about his family history and being a burden to loved ones. He doesn't want to write a six-figure check, and very concerned about the risk of dementia. So for Jeff, this one is pretty simple. We put together a 15-pay plan. Whenever you hear 15-pay, like single pay, 10-pay, 15-pay, what that's generally referring to is, on a guaranteed basis, how many premium payments are required. So 15 premiums being a 15-pay being 15 guaranteed premiums, and it's paid up on a contractually guaranteed basis. So for Jeff, 15 payments, which fits perfect because he's age 50. By age 65, he can enter retirement, not be on a budget. It provides him with benefits at age 70. And the reason I use age 70 instead of age 85 here is because that's what he's worried about. He's worried about early onset dementia. At age 70, $700,000 pool of money, $120,000 in death benefit, and $70,000 if he chooses to surrender and quit. So when we think about Jeff, number one, he's relieved. The situation with his dad's always on his mind. And he knows even if he needs care, he's going to be able to get it in his home where he's comfortable without being a burden to his children. Number two, he has an indemnity style benefit, which means that as soon as he qualifies for claim, he receives a check for the monthly maximum allotment. So if his children do want to come in and provide help, especially if they're having to cut back in hours, he has a way of compensating them. Number three, he's able to do this without compromising any of his other financial commitments. $5,800 a year to a high income earner is very manageable. So he's able to significantly mitigate a risk and give himself a lot of peace of mind without disrupting his lifestyle. And number four, should his biggest fear happen and he is diagnosed with a severe cognitive impairment, he can qualify for claim independent of the activities of daily living. So to kind of explain that, so generally speaking, you qualify for claim or client qualifies for claim by being unable to do 2 of 6 activities of daily living. Eating, bathing, dressing, toileting, maintaining bowel movement, bladder function, etc. Independent of being unable to do 2 of those 6, with most private long-term care insurance policies, a severe cognitive impairment will qualify him for claim. And that's an important note because when you see state-funded long-term care proposals and some of the proposals that have been proposed at a federal level, cognitive impairment is one of the activities of daily living and not necessarily an independent qualifier. So a big benefit for Jeff, given his level of concern and his family history. So next in our poll, in a recent study by One America, the one I've referenced with Hanover, what is the primary purpose of purchasing long-term care insurance? And this is from the client perspective. So it's them purchasing it. It's not necessarily from a financial planner. And we can see the answer is kind of shifting. Give everybody a couple of more seconds to get their answers in. And boy, yeah, you all have it. I think all of these things are absolutely go in the category of, the mentality of a purchase. But yeah, absolutely. Number one answer is not being a burden to loved ones. When financial service professionals were asked the same question, but kind of in reverse, which is, what are the primary selling points of long-term care insurance? 73% said removing the financial burden from family. So the word burden is consistent with both. So with both the consumers and the financial service professionals who are offering the coverage. But financial advisors specify that it's financial burden, but consumers cited the devastation of one's own finances and avoiding undue burden on one's family as being nearly equal. So I think the takeaway there is that it's important to discuss both aspects. The financial impact and taking 5-figure per month distributions potentially from a portfolio is absolutely a key part of the discussion, but I wouldn't underestimate the emotional impact and the becoming a burden to their loved ones because that's particularly important to people when having that discussion. All right, so case study number 4, meet Bruce. Bruce is a business owner, successful, and he is very connected with the need for long-term care insurance, particularly because he's single and doesn't have the traditional support, the traditional family support that many others have. And he likes the idea of protecting his lifestyle and protecting his portfolio through the purchase of a long-term care insurance policy. Yet, while he's committed to the idea of purchasing long-term care insurance and transferring the risk onto an insurance company, the current market environment is not one where he's very comfortable selling assets from his portfolio to free up a single premium to write a check. He just can't stomach the idea of losing the opportunity cost on his money and selling when the market's down. So we look at a solution that is what I call wait and see. And basically, rather than doing a single premium and having to sell assets when the market's down 20 or 30%, purchasing in a 10 pay, paying from income until he's more comfortable with market conditions and the market has appreciated, and then being able to tap into the portfolio to pay the premium off. So generally speaking, with long-term care insurance, the shorter increment you pay, the more cost efficient it is. So the most cost efficient method of purchasing long-term care insurance is going to be a single premium. 10 pay is going to cost more, and a lifetime premium is going to be the most. So here we look at a single premium requirement that would be $78,000 for Bruce. The 10 pay would be $9,700 a year for 10 years. But at any time those 10 years, he can pay it up. So the question is how could it possibly be in Bruce's interest to go with a 10 pay, recognizing that it's going to be an additional roughly $19,000 in premium? Well, it has to do with the size of his portfolio in combination with relatively poor market conditions. So to kind of walk you through this example, on the left-hand side, I'm going to show you the scenario like, what if he would have just sold assets from his portfolio to free up the single premium, and how would that have shaken out versus paying a 10 pay out of his pocket and then paying off the premium when market conditions improve. So let's start with paying the single premium. I'm using March of 2020 as an example because it's the most recent example of a significant market downturn. So here in March of 2020, Bruce's S&P share price was $2,652. He owned 500 units. He had to sell 30 of those units to free up $78,000 for the single premium. So his portfolio value at the end or in March of 2020 was $1,247,000, and he maintained 470 units going forward. February of 2020, things bounced back and the market appreciated. He's feeling better. $4,435 is the current share price. He owns 470 units still. The long-term care insurance premium's already paid, so that's off the table. So his portfolio value is $2,084,000, and he has 470 units going forward. Okay, so that's kind of our benchmark. Let's consider if he would have done the wait and see, which is purchasing a 10 pay, paying the premium out of his income, and then waiting till he's more comfortable with the market conditions. So here, the share price again in March of 2020 is 2,652, same, 500 units, but he's selling zero. He's maintaining all of it because he doesn't want to sell low. His portfolio value in March of 2020 is $1,326,000, and he has 500 units going forward. Now in February 2020, he's feeling much better about where his portfolio is. He's not feeling like he's selling low. $4,435 is the S&P share price, owns 500 units. And at this point, he's ready to sell. So he sells the remaining $78,000 that he owes on the 10 pay. So he has 8 payments left. Those 8 payments equal $78,000. And to make sure that we're comparing apples to apples, let's also assume that he's going to reimburse himself for the 2 payments that he's already made, which those 2 payments of $9,700 equaling $19,586. Would he actually reimburse himself? Probably not, but want to compare apples to apples here. So now he's selling, and his portfolio value after selling the assets from his portfolio ends up being $2,119,000, and going forward, he has 478 units. So in just 2 years, he comes out $35,000 ahead by waiting for market conditions to improve. So, you may look at this and say, well, what if it didn't bounce back in 2 years? Well, what if it was 4 years or 7 years or 10 years or 11 years? No matter if the market ends up appreciating into the level that it did, at some point in time, it's going to be the same $35,000. It may be a different internal rate of return, same $35,000. And yes, we didn't account for long-term capital gain rates here, but the capital gain rates between these two scenarios are long-term capital gain rates at $20,000. So we're probably talking about a difference of $4,000. He's still ending up tens of thousands of dollars ahead. So when we look at the benefits to Bruce, again, single man, no kids, wants to maintain a high quality lifestyle. Number one is he has peace of mind. Bruce knows that when he's unable to care for himself, he can receive care at his home or high quality facility. He's also preserved the opportunity cost in his portfolio, and the product provides him with $14,000 per month at age 85 in long-term care reimbursement. Number two is the concierge. One of the biggest unspoken benefits of long-term care insurance is the concierge benefits at the insurance carrier. They help coordinate things, help coordinate billing, receipts. They help find facilities. They help find elder law attorneys, a lot of the things that otherwise would fall into the family support that he doesn't have. And for a single person, this is exponentially more valuable. Number three, he's able to achieve a key objective by paying annual premiums until the market appreciates and he becomes more comfortable enough to sell the securities to pay off the long-term care premium. He feels like he's in control, which is important to him. And number four, by implementing the insurance today, rather than delaying the purchase until the market appreciates, he's locked in his age, his rate class, protecting himself should he have a change of health in the future. So a major benefit to Bruce. Okay, so now we've talked about funding with existing assets, funding with current income, and we move into funding through third parties. What's better than funding with existing assets or funding with existing income? Having somebody else pay for it, right? So let's look at a few scenarios there. Case study number 5. We have Helen and Monty. Helen and Monty are very generous people. They really care about helping their family. They deeply care about their family's lifestyle and comfort. And they're generous. So they've been using their annual exclusion gifts of $17,000 each year to help support the college tuition of the grandkids. The grandkids have now graduated from college, and Monty and Helen are already comfortable with the lifetime gifting, and they want to find a way to redirect those gifts to a way that can benefit the whole family and get leverage on their dollars without dipping in to their lifetime exemption. So we look at leveraging those gifts into a long-term care insurance plan that is going to benefit multiple generations of the family. So here, the grandparents are gifting $17,000 a year to the daughter. In our example here, so we're talking about the second generation. The daughter is a female, age 42. She pays 5 premiums of $17,000 to the insurance carrier. She immediately has a nice pool long-term care money, and at age 85 has a pool long-term care money of over $1 million, of which she can access $13,500 a month in internal rate of return on Monty and Helen's dollars of 7.7%, the pre-tax equivalent being much higher. So when we think about the benefits to Monty and Helen, number one is helping family. We have helped 3 generations. 3 generations are benefiting from this coverage. We have Monty and Helen, who know that their kids are going to receive quality care where they're not around to take care of them. We know that their kids, the second generation, have the peace of mind in knowing that they won't be a burden to their children and that they're going to receive quality care. And the grandkids, that third generation, they know that they're not going to be in a position to have to provide informal, unpaid caregiving. Big benefits. Number 2 is by purchasing the coverage on their daughter, who's just 52 years old, Monty and Helen are getting a lot of leverage on their premium dollars, one of their key goals. They also accomplish this without making significant, they also accomplished making significant gifts to their children without dipping into their lifetime exemption. And number four, they've reduced the longevity risk to their family. The simple reality is that the longevity risk is concentrated among affluent households. We know that the well-to-do have better access to healthcare, better access to high quality food, better access to exercise, and as a result, they live longer. And they're not going to qualify for Medicaid, or unlikely to qualify for Medicaid. And that risk of living a long time is largely attributed to healthcare costs, which have now been largely mitigated. So this is an example of the older generation gifting down. But what about an example or a scenario where you have a younger generation that has greater means than the generations that have come before them? Let's look at a scenario with Theodore and Anastasia. Theodore and Anastasia are star-crossed lovers who have created significant wealth through a leveraged cryptocurrency scheme that nobody but them seems to understand. They're avid travelers and imagine that someday they'd like to see themselves living abroad. Through a chance encounter at the gala ball, they ran into Lawrence and Josephine was distraught. Her mother was receiving round-the-clock care, and even for them, the cost was staggering. After the gala ball, Theodore couldn't stop thinking about his mother and what would happen if she needed care, and he called up his brother to arrive at a solution. And here's what that solution looked like. Theodore and his brother decide to evenly split a continuous annual premium to fund a long-term care policy for mom. They each pay $3,900 annually, both a premium that they're both very comfortable with, which provides mom with immediate long-term care benefits, and at age 85 provides her with benefits of $721,000 in long-term care funds, $169,000 death benefit, and they have the ability to surrender and give back their $78,000 if they need to. The benefits for mom at age 85 are $9,300 a month, an internal rate of return on Theodore and his brother's premium dollars at 9.6%, pre-tax equivalent, again, being much higher. So when we think about the benefits to Theodore and Anastasia, the first benefit, hands down, is protecting mom. You know, I made a joke and tried to bring some levity here with them being star-crossed lovers and the cryptocurrency scheme. It's just for fun here. And while I kind of made them look a little bit snobby, high income earner or not, everybody wants to make sure that mom is cared for. And that concern is even bigger when she's on her own and doesn't have a spouse that could provide any initial caregiving. So this policy provides a lot of peace of mind for Theodore and Anastasia and Theodore's brother. In addition to protecting mom's quality of life, they protected her assets from the risk of longevity. And they recognize that in doing so, they've also protected their own assets, recognizing that if mom can't afford to provide herself with care, the financial responsibility naturally falls onto them. They also have the peace of mind in knowing that if they choose to live abroad, the policy will pay benefits so that their future goals about where they live and their lifestyle aren't compromised because of an insurance policy's restrictions. Now, this does depend on the type of policy. So before you make any sort of recommendation on international benefits to a client, you always want to research the carrier and their perspective on that, because there is pretty stark differences carrier to carrier. And lastly, there is an ability for the brothers potentially indemnify themselves. So if the insurance goes unused, the brothers are 50-50 beneficiaries of the policy. If mom passes away, they have a means of recouping their premium contributions. So lots of benefits for Theodore and Anastasia. So we've covered older generations gifting downwards. We talked about younger generations gifting upwards. How else could a third party support funding? Well, naturally, it would be an employee-employer relationship. So our last case study here, we have Nate. Nate is a top salesperson for his company. After over a decade, he represents a large portion of the firm's revenue. He also holds key client relationships. Nate's boss, Todd, recognizes that Nate is an all-star performer. He recognizes that he is attractive to competitors, and he wants to make Nate's compensation arrangement more attractive and really provide him with an incentive to stick around. And the incentive that they come together with is a short pay long-term care insurance plan that incentivizes Nate to stick around, and at the end of a period of time can walk away with a fully funded long-term care insurance policy, really with no strings attached. So let's look at the mechanics of this. Here, the employer and employee enter into a legal agreement that basically says if the employee sticks around for 10 years, the company will provide him with a bonus every year to pay for long-term care. So the employee is purchasing the policy and owns the policy. Since the premiums are essentially being paid by the employee, the expenses are deductible as income to the family. The company is basically double bonusing the premium to the employee. In other words, they need to give him $7,265 after tax to be able to fund the full premium for the long-term care insurance. So they bonus him $12,108 so that after tax, he has the full amount to be able to pay the premium. So immediately there's long-term care benefits, and at age 85, there is a very large pool of long-term care funds, 1.2 million for Nate. Alternatively, Nate could say, you know what, that's a very large pool just for one person. I would prefer to fund a long-term care policy with joint benefits for him and his spouse. Same thing with a 10 pay. The company does the same double bonus, same premium, no difference in premium. And at age 85, Nate and his spouse have a pool of long-term care funds of $779,000. So what a great way to make Nate's wife also feel good about his position and his employer and feel like she's also being included in the benefits. So when we look at the benefits to Nate, number one, first and foremost, Nate has a planning mentality. He's seen his parents become caregivers and knows the cost, and he's relieved that he and his wife are protected from that risk. Number two, he's proud. His employer's made a huge gesture to demonstrate value and to demonstrate really the value that he brings to the organization, and Nate feels better about his position. Number three, he feels motivated. He feels incentivized to continue to produce at a high level for his company. And because he owns the policy, after the 10 years, if there becomes a better need for those dollars and he wants to reposition it, he has the flexibility to do so. So there's lots of benefits to Nate, but there's also benefits to the company. The company here being Todd. Todd has mitigated a significant risk to his company, the loss of a key employee who's holding many of the relationships and bringing in a ton of revenue. So he sort of built a moat around his key employee. He also gets a tax deduction because he's bonusing it out as income. He's got a motivated employee and an employee who has improved morale. And through the agreement, Todd has a means of recouping his investment under the terms of the agreement should Nate leave before the 10 years of the agreement are elapsed. If Nate does decide to leave under the terms of the agreement, he owes those dollars back to the company. So the company has protection as well. So we started off with nearly double the case studies that we covered today, and the funding methods are really countless. But I think it's important, as with any type of insurance, that the real key to a conversation with clients is to focus on the need. We're talking about a risk that is both large and probable. It's hard to imagine any other risk being more financially detrimental than the cost of needing substantial care during retirement years, and it's on your clients' minds. Here, you can see that the number 2 answer in terms of top financial concerns of adult Americans, these are Americans over age 40 who describe themselves as being in the process of retirement planning. Number 1 answer, naturally having enough money for retirement. Number 2 answer, paying for long-term care services if I become unable. So we learned earlier that about 1 in 5 financial service professionals is talking to their clients about the need for long-term care, yet it's on their mind. So this is a great opportunity for you to bring value to your clients. If you're a financial advisor, they may not be aware that you can help them with insurance. If you're a life insurance advisor, or maybe a property and casualty advisor, they may not know that you can specifically help with long-term care insurance. But as you can see here, they're thinking about it. So if you're unsure about how to go about making long-term care, making the long-term care discussion a regular part of your practice, it's about creating a simple process. Make an agenda item for when clients hit age 50. Show them options while they're young, insurable, get a lot of leverage out of their premium dollars, and have many years of earned income to pay for the insurance before they reach retirement. At BUI, we have sort of a fishbowl view of a lot of firms all over the country. In a simple process that seems to work is, number 1, have a predictable way of communicating the value to clients. As I said, putting it as an agenda item when clients turn 50. We're going to have this conversation. Number 2, having a way of drilling down what's really important to them, where they want to receive care, their family history, their medical history, their levels of concerns regarding aging. This will allow you to create a customized plan that fits their unique goals and objectives. And I really think it's important to dedicate a meeting to this topic. Educate them on the risk, the products, and how your recommendation directly alleviates their goals and objectives. It's too big of a topic to squeeze into a 60-minute meeting with 2 or 3 other agenda items. And I would, if anything else, I would strongly encourage you not to just send them a quote. If you send them a generic quote and say, let me know if you have any questions, they're going to get a proposal from an insurance company that's really confusing. They're not going to see how it directly alleviates their concerns, their goals and objectives, and it's going to leave them confused and uninsured. And it's really just not a process that I've ever seen work. So with that said, I thank you all for your time and attention, and hope that you feel that these case studies were something that can help be practical, that can be practically applied to help your business and your clients.